Hey guys, what's going on? It's Matt and Sean here for another week podcast going through important real estate, Lehigh Valley news you need to know as we wrap up the beginning or the end of this year and beginning of next year of what's going on and recap. Article that came out that we kind of want to go over. Kind of went through some bullet points, mainly about statistics on first-time buyers and repeat buyers. Kind of trending different.
Yeah, much different. So, biggest thing out of the article that I take is that the average age of a first-time home buyer is now 40 years old. Yeah. Which, when I remember when I bought a house, it was like 27, 28 years old. That was about 20-some years ago.
Yeah.
And, that's an increase of 2 years. So last year the average age was 38 years old. Mm-hmm. So that was one of the biggest takeaways of that article.
It's like when the interest rates are 6.99 and then they're 7. It's like the sky's falling.
Like 6, 7.
Like 6, 7. 6, 7. Had to do it. Sorry, guys.
Sorry.
But that said, it's a when you look at it too, I saw in the same article, it was something where the same person, if they would have bought when they were 33 or 30 versus 40, they lose out. The average nationally, they lost out on $150,000 of equity. That's just what it is. It's just lost equity that people don't have, and that helps build wealth. I mean,
absolutely. I mean, obviously, we talk about this all the time, but buying a house is probably the best investment you'll ever make in your life. And is it hard right now? Yeah, it's hard. Mm-hmm. I think the essence of that article is, why is it that the average age of a first-time home buyer is 40 years old, and what can we do to fix it? Right.
Yeah.
And there's a lot of things that are kind of hanging over. We spoke on the last episode about, the cost of home ownership, not just the interest rates and, how much the homes are, but how much you put into that home. So this article was great because I think it focused on things that are being done or could be done, like the Trump administration potentially declaring a housing emergency, which I'm fully expecting that to happen, and so coming out of that, what's going to be in that housing emergency is just going to make everything more affordable and cheaper. Yeah. It's going to be able to put for builders to build homes because we got a shortage of inventory, right?
Big time.
So supply and demand, it's
That's not going away anytime next year.
Correct.
Horizon. I don't see any of that.
Correct. So, but if the builders could make it easier for them to build, we put more inventory in the market. If we, Congress passes a bill that lowers or raises the threshold for capital gains, it'll put more sellers in the market to sell our homes. Yeah. Raising it from $250 to $500 for a single filer, $500 to $1 million. For a joint filer with
huge
adjustments for inflation.
Yep.
That's going to make more sellers, older sellers, or longer tenured sellers willing to sell.
Yeah. And that's what so many of them too, have like the golden handcuffs. They are in at those 2 and 3% interest rates. They're not going anywhere. They might have been more inclined to move, but now they're staying put, which leads into the second part, the repeat buyers that we had statistics on that. Average age of the repeat buyer was all the way up to 62 years old now.
Could you imagine that?
Yeah.
Could you imagine you don't buy a home until you're 40 years old?
Yeah.
And then you don't buy your second home until 62. I remember when I first started in the business, the average person stayed in their home only 7 years.
Yeah.
7 years, and then you moved and you bought another home. So what this tells me is the average person is buying a home at 40, selling it and buying a second home at 62.
Yeah.
That's kind of like they're holding on to a home for 22 years.
Correct. Yeah, I saw the same. It's like everything just shifted. The whole age bracket just shifted up a bit, a lot. And then on top of it too, I think on that article, 30% of all the repeat buyers that were 62 years old pay cash. Yeah, the cash buyers.
So how does the first-time home buyer compete against the second home buyer who's paying cash? The 30% of them that are paying cash.
It's uncanny how many times I have offers go out over the weekends. First-time home buyers, even if they might be even repeat buyers that are younger in age, that don't have as much equity built And they are. They're up against those cash buyers that they have their home is free and clear. They can pull monies from their investments or retirements, then sell their house afterwards. What do you think going into next year, 2026, from this year? Do you think we're going to see more in terms of equity, people using equity or cash? What would you project, and if best of for going into next year for those repeat buyers, selling their house, and what's the landscape going to kind of look like if you had being a real estate agent?
Personally, I think the repeat buyers are going to have equity to use as cash. So either paying cash for the transaction or a very large down payment with a small mortgage. I think that we're going to see the same kind of activity that we saw the last few years, as far as not enough inventory, a lot of competing offers, a lot of multiple offer situations on really good homes. However, I also think that we're going to start seeing a little bit of a slowdown because of the affordability issue. I think we're already feeling it this winter, where there's less activity on listings, there's less showings, less multiple offer situations. So I think there's an opportunity. Like, I think the really good thing is if you're a buyer and you're pausing this year because of the holidays and winter being here, and you want to just like pause until it gets warmer out in the spring, because that's what we're seeing. The first time in about 5 or 6 years that we've seen a slowdown in the winter. You shouldn't slow down, because now there's an opportunity for you to go and submit offers and get them and not have to compete against that cash buyer. So don't take your foot off the brake or off the gas. Think about it.
Don't pump the brakes.
Don't pump the brakes. Just keep going. Find a house. There's inventory out there that right now that's sitting. I don't think that's going to continue like that. I think this spring, when things start heating up again, it's going to heat up again.
I agree. I agree at tenfold, and that's where I see people that, to your point, kind of slowing down a little bit this year in 2025. And you and I had talked earlier this year about it. A lot more normality, the way it used to be before COVID. We had COVID; it was nonstop, gas pedal down all the time, crazy offers. It didn't matter what time of year it was, and that's where we're seeing, and I'm seeing, like during that time of year, you have your August, your late July into August, where people are now taking those vacations. It's slowed down a little bit just because that historically was a little bit of a slow time before school and getting settled, and then you go into the holidays in the winter, and to your point, that's going to leave a window of opportunity.
So it's a huge window of opportunity that people don't realize that you could actually go into a house right now and submit an offer and actually get something accepted other than asking price or higher. There's still sellers out there that want to sell. And I'm not saying by all means that this is the change of the market. I just think that it's a more normal market than what we've been used to.
I will take it
1,000%
all day.
This is a great opportunity for those first-time home buyers to go find something that they really like and can afford.
And to cap off kind of with today's conversation too, a lot of as the rate talk with interest rates and where they are and where they're going. The Fed did cut their interest rates from the last time we know. They cut another 25 basis points, but it didn't have any impact on your mortgage rates because those follow 10-year treasuries and bonds and a whole different animal. Your car loans, your home equity lines of credit, credit cards. Yes, we're going to see some adjustments in those, but your mortgage rates follow a whole different beast that have to adjustments with employment projections and inflation projections. So nationally across the board, like we're like a 6.2, 6.3 as a 30-year fixed rate. And going back 30, 40 years, this is around the national average of where rates are and have been. We saw those very low rates during COVID time and the pandemic time, but getting out of your head of like these rates are too high. It's a combination of affordability, like you said, absolutely. That's coupled up with home prices all day long. That's something that's going to be hard to correct if you are going to. You have to do programs for that and things. But going through and waiting for those lower rates. I mean, I have a lot of people refinancing right now because you know what, I can't wait. If they go down to 5.5 or 5.6, great. I can't wait 2 or 3 years for that.
Date the rate, marry the house.
Exactly. I was just thinking that exact quote. So,
what do you think? What's the forecast for rates next year? What do you think?
So I would say the best I can tell for next year, if we see anything, a lot's going to depend on Fed Chair Powell. He's out. He's going to be gone. So President Trump's going to elect the next Fed chair. That's going to go through. Now, there is a committee that goes through, and they all vote on where things are going to go. But rightfully so, when he appoints who he appoints, they're going to be pro-cuts. They're going to want to, that's just his agenda with getting those rates as low as possible for affordability, which we do need. So it's going to be kind of skewed in terms of how many more cuts. I think we might see a little bit of a pause in spring. I don't think we will see too much more. I'm looking more towards like third quarter of next year once we get more data and see about inflation. I think inflation is going to be the driver. You know,
So you think all next year we're still going to be between like 6 and 7?
6, 7, 6, 7. I do. I think we're going to be in the 6. I do. I think we'll be somewhere in the 6s. I think National Association, the president, she said as well, or he said that it's going to be somewhere in the 6s. You know, going through the projections. So you know, I think the one statistic, it was about waiting from a 6.2 or a 6.1 to a 5.9 or a 5.8 was like $50 a month on the national. So it sounds like a lot, but it's $50. You know, that's I keep telling people that's your DoorDash. Like, stop. Just you're going to lose out on all that equity on that property. So yeah, so big takeaway I think for this year and into next year is more of the same. Hopefully, a little bit of kind of switching a little bit in terms of helping those buyers and the first-time home buyers. But yeah, it'll be interesting to see.
Look for something in January to happen at the federal level. I really think that something's going to come out that's going to really help the housing market and the affordability.
I would welcome it. If anyone knows, you do. I mean, with everything you do with the National Association and everything, all your involvement. So, yeah. All right, cool. Well, Sean, if I don't see you, have a happy holiday.
Yeah, you too.
Take a break on this, guys, and we'll be back after the holiday. Any questions? As always, mortgage stuff, real estate stuff, we're here to help at all times. If we don't talk to you, have a fantastic holiday. Merry Christmas, Happy New Year, and we'll catch up with you guys next year.